How's my hair? Hey guys, how's it going and thanks for coming. I'm Nick and this is Real Life Money, where we talk about real life and money because you know schools aren't. Don't forget to subscribe for more videos, so let's get started. So in this video, guys, we have a three-way race. We are going to be comparing stocks to mutual funds to ETFs. Stick around. Now, of course, there are pros and cons for all of them. I'm going to be going into really the basics, whether if you're a beginner, if you're more advanced, but to see which is best for you. I think they're all great investments, essentially. Definitely better than just a savings account, but some might be a little bit better strategy for some people. First, starting off with stocks, the most attractive that everyone is very interested in, of course. So if you're investing in stocks, I think like one of the most important factors that we have to understand is that it requires a lot of time and research to go into each individual stock, each individual company. We have to look at all the different financials, look into the business, look into the price of the stock, look into income statement, balance sheet, cash flows, conference calls, ratios. If I'm already boring you, then maybe stocks aren't the best choice for you. However, the benefit of that is that you can make very nice returns in individual stocks. And if you do it correctly, you can beat the overall market, which a lot of people try to do. So let's go over some examples of companies that actually did go up very nicely and beat the market. I'm giving you some popular ones, but we can see Netflix year to date is basically almost 100% return, which is ridiculous. Another one is Amazon, we all know and love. Year to date is 70%. 1 year change is 100% as well. Very popular out there is Salesforce. I've been hearing a lot of them on the news. Jim Cramer talks about them a lot. But year to date, over 50%. 1 year is 60%. And again, hot industry right now especially is marijuana industry. This is one of the top marijuana companies. Canopy Growth year to date over 100%. So you can see these returns for these companies are amazing, and it's definitely possible to get it. However, on the flip side, it's all not daisies and rainbows. There are gains, but also losses. So let's look into some of the losses. A hot stock that has not been so hot recently with the semiconductors is Micron. 6 months, they have been down 30%. Company that we all know is Facebook, and they're not doing so hot. Year to date, around 8%, 1 year down 6%. I personally think this is a buying opportunity, but still the stock is down, so you could have lost money with that. And Snapchat, a lot of people thought this was a great investment. I mean, it could still change around, but currently it's down over 30%. So you could see there are rewards out there, but there are also risks. And also understand that a lot of people, well, everyone tries to beat the market, but not everyone does. So this leads perfectly into mutual funds. If you have limited time or not too interested in diving really deep into specific companies, we could take a basket of stocks. That is basically what a mutual fund is, a bunch of stocks in one investment. So if you still want to invest in stocks, want to invest in the stock market because you understand that they're probably going higher in the long term, so you want to invest in that, this is a great choice for you with less research. Now, kind of a downside is that the gains aren't as high as individual stocks. Like we saw before, couple companies like Netflix, they're around 100% return, when some mutual funds don't have those highs because there's a bunch of stocks in there. One stock might go up, but the other stocks basically hold it down. However, on the flip side, it also holds you up. So if one stock goes down, the whole mutual fund doesn't go down dramatically like we saw with Snapchat down 30%. The other stocks hold it up because of the diversification it has amongst lots of stocks. So a couple examples of well-known mutual funds, couple that I like. Fidelity Contra Fund, you can see the 1 year change is still up over 20%. However, it's not as huge as other returns, but still nice. Same thing with Dodge and Cox. That 1 year return is over 17%. Still very nice. Actually the market is slightly lower than that, so it kind of beat the market in the short term anyway. But again, still not as high returns as those high stocks. But again, it doesn't have those huge lows like some of those other stocks as well. Now, of course, the easiest way to invest in mutual funds is through an index fund. So in case you don't want to do any research at all, you don't know which fund to get into, just follow the overall market. A lot of people follow S&P 500. So it has 500 of the largest companies in there. That's basically the economy. In addition, I also love mutual funds because you can have monthly investments into them, like automatically. So personally, I have money coming out of my checking account, savings account, whatever it is. It's coming out of that account every month, and it's getting invested into mutual funds. So over the long term, it goes up and happens automatically. So partially, I believe everyone should have a certain percentage in mutual funds because it does kind of stabilize your investment. It could still grow, but it doesn't have that huge downside potential overall. Like if the stock market drops, mutual funds are going to drop just as well. But it's easier to invest in. It's great to start off with and has that diversification. But if you want the best in both worlds, you want something like a stock, but mutual fund, that type of diversification, are ETFs. Those stand for exchange traded funds. Essentially, they're basically like mutual funds, a basket of stocks, but they trade like a stock. See, with mutual funds, if you want to buy or sell any amount within a mutual fund, it usually happens at the end of the trading day. And it depends on the amount of money. So you would have to either put in $5,000, take out $5,000, whatever amount. I'm just picking $5,000. But with ETFs, they're like stocks, like we said. So you have shares. So you could buy or sell 100 shares whenever you want, just like a regular stock. Now, I personally think this is a great starting point for people getting involved or just started with the stock market because you have that diversification. It is a good investment, especially for the long term, but the minimum to start is much less usually than a mutual fund because mutual funds usually have like a minimum balance, could be maybe like $2,000. So if you don't have $2,000, you could simply buy a couple shares of an ETF. Let's look at some examples. So first we can see QQQ. This is basically mirroring the NASDAQ. It has a bunch of technology stocks. So you can see kind of similar to mutual fund returns, around 17% year to date, 1 year almost kissing 25%. On the other hand, or another ETF, is what we were kind of talking about before, mirroring the S&P 500. This is SPY, or spiders. This mirrors 500 of the largest stocks. Year to date, 8%. 1 year, over 15%. So you can see the similarities they have to mutual funds with their returns, but also kind of a little bit more flexibility with stocks. Now, they're not, depends on your strategy, but with that automatic monthly investment, like we said with mutual funds, you cannot do that with ETFs normally. With an ETF, you would have to manually go in, set up a trade, and invest that every single month, where a mutual fund, you could just set it up and never look at it again. Now, that doesn't mean that it's a bad thing. It's just It's kind of a fact. But again, ETFs are a great investment. Still investing in the stock market, more diversification, less startup capital, basically. And also realize, if you're investing in mutual funds or ETFs, that is going to more closely mirror the market returns. Like we saw before with stocks, that's a way that you could actually beat the market very nicely. And another quick example of an ETF, just because I can, but this is actually an example how you could not only invest in stocks, you could also invest in real estate. So this is Vanguard Real Estate Index Fund. This kind of mirrors some of the REITs on the market. Again, you could see that these returns are a little bit less than individual stocks. And this is completely different from our stock returns. You can see this is much lower, basically breaking even year to date. So it's a little bit more diversified. You have some stocks and you could have some real estate. It's really up to you. By the way, if you're interested in some of the top ETFs out there, I have another video on that, link in the description. And also real quick, some new investing apps like Robinhood. You can't buy mutual funds through that. You can buy stocks and also ETFs, because ETFs are like stocks. There's a link in the description for that too. So what do you think, guys? Do you like stocks, mutual funds, ETFs, or maybe all of them? You know, they're all different types of strategies. It's not like one is better than the other. It depends on what type of investor you are. And don't forget to subscribe to my channel, guys. Thank you so much for watching, and I'll see you in the next one.